Okay, so it was quite amusing to be able to see the results of the poll. But it's nice to see that we've got a lot of technicians on board. So I hope that many of you really can be rendered on track with what we're going to be talking about today. Now, in our ability to be able to move forward from those, I did find it also quite curious that many of you were a little bit broad in your reasons for buying stocks, and it seems that your selling seems to be much more formidable in terms of your ability to use technical analysis. But I did still see some people, at least they were clear enough to be able to admit that emotion was a problem. Some of you blamed it on prices not moving too fast, and these things tell me that since you've got such a broad range of explanations as to why, there's still quite a number of people out there, have not been able to accept the fact that there really is only one enemy in trading, and it's seated in the chair that you're currently seated on. So you've got to be able to groom that person into something a bit more formidable, something where the blame game, disappears, because every decision you make, every position you take, every buy and sell option you decide to be able to address and take on is really taken on by you. And given that, and since you're in the captain's chair in all of this, you have to be able to make sure that you're trained well to be able to fly this airplane to where it wants to go. And if you start pulling on the wrong gears, punching the wrong buttons, pressing the escape pod before you should, and those are the things that can come inside and ruin our plan altogether. And so the reason why we're talking about the trading plan today is because, yes, we know all the concepts, we understand what to do. We talked about trend lines, we talked about technical indicators, we looked into the markets that need to correct and consolidate. But now we have to put all those things together, and you have to be able to assess for yourselves, okay, is it time for me to enter this stock? Is it time for me to be able to push myself out? And so today we'll talk a bit about that. We'll use a lot of the things that we also learned in the last few sessions here. And I hope that you'll be able to find a bit more insights into what we're going to be looking at today, because this is really very important, because it's not just all about concept, it's all about execution. And in the right aspect of executing your trades, you have to have a plan to do that. You can't just wake up one morning and say, I feel like doing this, or you're watching the market this morning, you have no plan in mind, and you decide to go in attack mode or in defense mode. And that could change day by day. And the results of a trading plan that has no plan is just going to be an arbitrary number. Some days you make money, some days you lose, and in the end, you're playing a zero-sum game. So we're going to try to structure all of those things in our ability to look into the trading plan today. So let's get right at it. All right, so let's just quickly summarize what we talked about last time. We did talk about technical indicators, and we assessed that technical indicators are like momentum gauges that tries to be able to figure out how strong is a trend. And the job of these technical indicators is to help us to make an assessment of market condition. Gives us an alert. It can actually confirm our suspicions that a trend activity is happening or is taking place. It can also generate certain degree of predictiveness in terms of activity on price. And we use these technical indicators to lend a hand to what we're kind of looking at in terms of trends and area patterns. Remember, technical indicators should not work on their own, should not be given the top priority as against the first two. They should work to complement the system. So for example, if you're driving your car, you look at your speedometer just to get an assessment of how fast you're going. So in case you're going to have to brake, you know how much time you need. And that's what a momentum indicator does for you. Or if you look at your gasoline gauge, if you're trying to be able to travel, let's say you're trying to go another 200-300 kilometers and you're running low on gas, you quickly make an assessment of that. So you say, I'm not going to reach my endpoint, so I've got to be able to load up first. So the job of an indicator really is to give you a sense of preparation, so that what you're actually going through is not just going to blindside you. And that's one of the very, very root of positive assessments of these things can give you. But one thing we have to understand is that momentum indicators do not work well in a consolidation, because in a sideways moving market, there is no momentum. And so our reliance on these indicators during sideways markets should actually go down. And hopefully we can make some assessments of that later. But the whole idea is use these indicators when you're supposed to. They work well in trending environments, up and down. But in sideways moving markets, you don't. You just pretty much use a support and resistance game. So last time we introduced the indicators called the moving average, the MACD, and the RSI. And I plotted them here on the right side so you can get a sense of what they will look like. So the moving averages are lines that follow prices. We said that these lines, just like a trend line, can act as support and resistance. So if we see that prices are breaking through them, just like this, then it can trigger on a selling condition for us. Or if it manages to bounce above it, then it creates itself like support and allow yourself the ability to buy right off that. So for example, if I'm going to be looking to buy, I can buy any of these periods. I'll probably be selling here. I will be buying back my position here, and or start selling it when it starts breaking the moving averages here. All right, then we talked about the MACD, which is a good momentum indicator, although it is lagging. But it does give you a good hand of telling you whether the buy mode of a market is still inside or whether a sell mode has come in, and that we have to be able to follow it. So just for example, in this up move and a turn down that we see here in first gen, you can see that the MACD gave us a buy signal here, and it gave us a sell trigger here, and it seems to have worked well, trying to gauge whether this upward trending market will continue and whether it started to be able to falter and fall short of it. So again, we also make use of this in terms of studying momentum. And finally, we talked about the RSI. The RSI is an overbought and oversold indicator. And we said that if the RSI indicator, which is this line here, attempts to be able to tag or surpass this upper boundary line of 70 or 80%, then we say the market is overbought. If it falls all the way back down and hits a 30% zone or lower, then it's called an oversold market. An overbought market is a market that climbed up too fast too soon and could be ripe for profit taking. An oversold market could be a market that's been falling down quite heavily, and because of the oversold condition, it could condition some other bargain hunters to come into the picture and cause the market to rally or at least go sideways. So we use these indicators to give us a much more fleshed out environment, and so we can assess the condition of the stock trends a bit better. Sometimes you would need these indicators to see more visual of that rather than trying to be able to let your mind just generate that on your own, because sometimes it might be difficult to be able to make that assessment. But with using the moving average, the MACD and the RSI together, it should be able to give you a good gauge on how to track the market well.